Most entrepreneurs believe there's one thing standing between them and real growth: access to a bank loan. But that's one of the biggest myths in business. Companies rarely fail because the idea wasn't good enough. More often, they fail because they run out of cash at the worst possible moment. In this video, you'll discover 7 proven ways to finance your business without relying on a bank loan, even if you're starting with limited resources and no investors lined up. These are practical, legitimate funding strategies that thousands of successful entrepreneurs across the United States use every day. We'll break down how each option works, who it's best for, and the common mistakes that cause many new businesses to struggle before they ever gain momentum. Make sure you stay until the end, because one of these strategies could completely change the way you think about funding your business. The first option is bootstrapping. Bootstrapping means launching and growing your business using your own savings and the cash your business generates instead of borrowing money or bringing in outside investors. Many of today's most successful American companies, especially in technology and e-commerce, started this way. The greatest advantage is that you stay in complete control. You keep ownership of your business, you don't answer to investors, and you avoid the pressure of monthly loan payments. But successful bootstrapping isn't about emptying your savings account and hoping for the best. It's about starting lean, testing your market quickly, and reinvesting every dollar of profit back into growth. Keep overhead low, avoid unnecessary expenses, postpone expensive office space, hire only when it's absolutely necessary, and focus your budget on activities that directly generate revenue. Bootstrapping naturally builds financial discipline. It teaches you how to manage cash flow, prioritize spending, and make smarter business decisions from the very beginning. This approach works especially well for businesses that can begin earning revenue quickly, such as consulting firms, service businesses, digital products, freelance businesses, and local companies. Many entrepreneurs choose this path because it creates healthier, more resilient businesses over the long run. The second option is funding from friends and family. For many American entrepreneurs, this is one of the earliest sources of startup capital. The biggest mistake founders make is treating these conversations casually instead of professionally. If you choose this route, handle it exactly like any other business investment. Clearly explain your business model, the risks involved, and how every dollar will be used. Decide from the beginning whether the money is a loan, an equity investment, or a revenue sharing agreement. Most importantly, put everything in writing, even if it feels awkward. Clear documentation protects everyone involved. One major advantage is flexibility. Friends and family often believe in your vision long before a bank or investor ever will. At the same time, be careful not to raise more money than you actually need and never promise guaranteed profits or returns. Honest communication is essential. When handled professionally, this type of funding can help launch your business without the burden of interest payments. When handled carelessly, it can permanently damage personal relationships. That's why professionalism matters just as much here as it would with a venture capitalist or angel investor. The third option is customer-funded growth. This is one of the smartest ways to finance a business without taking on debt. The idea is simple. Customers pay before you've fully delivered the product or service. That could mean pre-orders, deposits, subscription plans, retainers, or advance payments. Many businesses across the United States use this strategy to confirm market demand while generating the cash needed to operate and grow. The biggest advantage is obvious. You take on no debt, give up no ownership, and gain immediate proof that customers actually want what you're building. Instead of relying on outside financing, your customers become your source of capital. To make this strategy work, be realistic about delivery timelines, consistently provide high-quality work, and communicate openly throughout the process. Never make promises you can't keep. Customer-funded growth works especially well for SaaS companies, consultants, coaches, manufacturers accepting pre-orders, agencies, and service-based businesses. If people are willing to pay before receiving the final product, that's one of the strongest signs that your business has real market potential. It reduces financial risk while giving you confidence to keep growing. The fourth option is crowdfunding. Crowdfunding allows you to raise capital from a large community of supporters through platforms like Kickstarter, Indiegogo, and equity crowdfunding platforms available in the United States. Instead of depending on a single lender, you receive smaller contributions from many people who believe in your idea. Its biggest advantage is validation. When people are willing to financially support your product before it's widely available, they're showing genuine market demand before you invest heavily in expansion. There are 2 primary approaches. Reward-based crowdfunding is ideal for consumer products, innovative gadgets, and creative projects. Equity crowdfunding allows startups to raise capital by offering investors a small ownership stake in the business. Success depends on telling a compelling story, clearly communicating the value of your product, and setting realistic expectations. People need to understand why your idea matters, how their money will be used, and what they'll receive in return. A successful crowdfunding campaign doesn't just raise money, it also creates early customers, builds brand awareness, and generates valuable momentum before launch. But preparation is everything. Without careful planning, a campaign can fail publicly and make it much harder to build credibility later. When executed well, crowdfunding can provide the capital you need to grow without taking on debt or making loan payments. The fifth option is working with angel investors. Angel investors are individuals who invest their own money into early-stage businesses in exchange for an ownership stake. In the United States, they typically invest smaller amounts than venture capital firms, but they often bring something just as valuable: experience, industry knowledge, and a strong network of connections. The biggest benefit isn't just the funding, it's the guidance. Many angel investors have already built successful companies or gone through profitable exits. They understand the challenges founders face and can help you avoid costly mistakes, make better strategic decisions, and connect with customers, partners, or future investors. To attract the right angel investor, you need more than a good idea. You should have a clear business model, evidence that customers want your product or service, and a realistic plan for growth. Investors want founders who understand their financials, know their market, and can clearly explain how they'll use the capital. The trade-off is giving up some ownership in your business, but the right investor can often help you grow much faster than you could on your own. This funding option is ideal for entrepreneurs who value mentorship as much as the investment itself. And remember, choosing the right investor is just as important as raising the money. The wrong partner can create bigger problems than having no investor at all. The sixth option is strategic partnerships. A strategic partnership means working with another company that has a shared interest in your success. Instead of simply writing you a check, that partner might provide manufacturing support, technology, distribution, marketing resources, or operational expertise. In return, they gain access to your product, your customers, or a share of future revenue. This is one of the most overlooked ways to finance a growing business. For example, a supplier may help finance inventory, or a larger company may agree to purchase your product in advance through a long-term agreement. These arrangements reduce the amount of cash you need up front while helping your business grow faster. The key to making strategic partnerships successful is making sure both sides benefit. Every responsibility, expectation, revenue arrangement, and exit strategy should be clearly documented before moving forward. This approach works particularly well for B2B software companies, SaaS businesses, manufacturers, and service-based companies. A strong partnership can provide the resources you need to scale without taking on debt or paying interest. The seventh option is grants and business competitions. Grants and startup competitions offer funding without requiring you to repay the money or give up equity in your company. Before you consider applying for a business loan, watch our next video on how to improve your business financial management so every dollar you earn works harder for your company. If you found this video valuable, be sure to like, subscribe, and share it with another entrepreneur who could benefit from it. Thanks for watching, and I'll see you in the next video.